Hi, I'm Kelly, and today myself and my fellow group members will be explaining special purpose acquisition companies in further detail. Special purpose acquisition companies, otherwise known as SPACs, are shell companies with no assets nor commercial operations except for cash. These blank check companies are formed with the sole purpose of raising capital through the initial public offering, commonly known as the IPO, and then acquiring a private company to eventually turn public. A SPAC transaction involves 3 steps. First, the IPO. Second, searching for a target business to acquire. Third, approval and closing of the transaction. This process is similar to a traditional IPO, but is a considerably simpler and faster method for a business to go public. The traditional IPO involves fully developing a business to eventually grow in scale to raise proceeds in public markets. This is a very lengthy and tedious process involving filing substantial amounts of paperwork with regulatory bodies, approaching institutional investors, paying investment bankers to assist in the process, and last but definitely not least, paying underwriting fees worth up to 10% of the raised proceeds. Due to these disadvantages of the traditional IPO, SPACs have become a popular form of investment in the past few years. In the first step of the transaction, the founder, also referred to as the sponsor, convinces public investors to raise funds and in turn use those funds to acquire a private company to turn public. Once the SPAC is successful in garnering the investors' interest, the founder IPOs the SPAC. And due to its nature as a shell company, the process is far less costly. The equity that is issued involves units of stocks and partial warrants that can be exercised in future periods. This will be discussed later in further detail by Anastasia, but for the time being, warrants provide an additional incentive to invest in the SPAC. The proceeds that are raised are kept in a blind trust account for which sponsors have access to opt out anytime or approve an acquisition with. The next step involves searching for a private company to acquire within a 2-year timeframe after the IPO. If sponsors fail to do so, investors are entitled to have their funds returned. However, in some situations, this may incentivize the sponsors to move forward with a potentially unattractive acquisition due to time constraints. This brings us to our final step. In most cases, when the sponsor finds a target business, shareholders' approval must be obtained by filing a proxy statement. Alongside this, the redemption of common stocks must be carried out for investors opting out of the transaction. Once the acquisition agreements are all finalized, the private business now becomes a publicly traded company, with directors from the SPAC and the original private business running the company. I will now hand it over to Caitlyn.
Thank you, Kelly. Hi, my name is Caitlyn, and I will be providing greater insight into the advantages and disadvantages of taking companies public through SPACs. SPACs have become one of the favoured ways for many management teams to take companies public, due to their many advantages. Choosing SPACs as a way to transition to a public company can benefit sponsors, investors, and target businesses. These advantages go beyond the shorter timeframe in comparison to traditional IPOs, as previously outlined by Kelly. In comparison to private placements, SPACs provide greater access to potential investors. They also allow investors to co-invest with successful sponsor firms and individuals, providing certain liquidity provisions and offering protection measures against potential downsides. This is also beneficial to the transition, as SPAC sponsors are often experienced financial professionals who can provide contacts who offer management expertise or take on a role on the board themselves. Investors are also benefited through step 2, as outlined by Kelly, as they decide to support or reject the deal through a proxy vote, meaning they possess great power in deciding the direction of the transaction. Additionally, SPACs give privately held companies easier access to public markets, particularly during market instability. This access to capital can fund operations and growth strategies, while still allowing existing owners to share in the growth through stock rollovers. Further capital can also be gained by a SPAC through private investment in public equity funding, also known as PIPE funding, fueling growth for the combined company and ensuring a completing transaction. However, like any financial instrument or entity, there are also disadvantages to SPACs. These cons are in addition to Kelly's observations, such as the challenge of building regulatory requirements in a reduced timeframe. Similar to IPOs, if the market is not as receptive as expected, SPACs are susceptible to execution risk. SPACs can also raise governance and management issues if the agreement integrates the target company's management with the SPAC's management team. Moreover, while waiting for a suitable target, the invested capital in the SPAC trust is inaccessible. This could be seen as a disadvantage to investors, whereby the capital could be making a higher return elsewhere and may result in initial investors redeeming their shares. There is also a risk that the sponsor never finds a suitable target and the SPAC may be forced to liquidate, which is not the return the investors would be hoping for. However, if the sponsor identifies a potential business combination, the investors can reject any proposed business combination as previously discussed, being a risk to sponsors and the target companies, which a standard IPO does not need to consider. Finally, shareholder dilution can also occur, as sponsors usually own a 20% stake in the SPAC through founder shares as well as warrants to purchase more shares. I will now hand it over to Anastasia to provide further details about warrants in financial reports.
Thanks, Caitlyn. Hi, I'm Anastasia, and I'll be talking about how warrants are accounted for in financial reports as per current practice. Before discussing how warrants are accounted for in financial reports, we must first define what warrants are. Warrants is a premium that is paid on top of the exercise or strike price of the security in order to give the buyer a right to buy that stock at that exercise price in the future up until the expiration date. Companies usually issue warrants to make the securities more attractive to buyers. Warrants can be very useful in attracting investors for companies that need to raise capital early in their life. So the 3 steps to accounting for warrants in financial reports are: firstly, to determine whether the warrants are classified as an equity and liability; 2, to calculate the fair value of the warrants; and 3, to allocate the value of the warrants and the securities. So the first step to accounting for warrants is to determine whether the warrants are classified as a liability or as an equity. According to the US generally accepted accounting principles, or also known as GAAP, warrants can be classified as an equity when they're indexed to the entity's own stocks. Meanwhile, warrants can be classified as an asset or liability if the warrants require some form of cash settlement in the future due to an event that is not within the entity's control. The second step to accounting for warrants is to calculate the fair value of the warrants and the value of the debt or equity the warrant is attached to. The purpose for this step is to be able to calculate and determine the face value of the sale proceeds that came from the sale of the warrants. Step 3 to accounting for warrants is to allocate the value of the warrants and the securities. This also depends on whether the warrants are classified as an equity or as a liability. So firstly, if the warrants are classified as an equity, the proceeds from the sales of the fair value of the securities and warrants should be allocated independently. As it can be seen in the table displayed on the slide, if the fair value of the securities is $750 and the fair value of the warrants is $250, then 75% of the proceeds will be allocated to the securities and 25% to the warrants. The amount allocated to the warrants will be recorded as additional paid-in capital warrants in the journal entry. So secondly, if the warrants are classified as a liability, the sale proceeds must first be allocated to the warrants at the warrant's full fair value before allocating the rest of the debt or equity offered. So for example, assuming the fair value of the securities is $1,500 and the warrants is $500 and the sales proceed is $1,000, $500 must first be allocated to the warrants and the rest $500 will be allocated to the securities. So it will not be allocated percentage-wise, unlike how it was allocated if it was in equity, as it can be seen in the table displayed on the slide. And in this case, the journal entry to record the warrants should be warrant liability. So now Celina will be talking about the main accounting issues of warrants as identified in the US Security and Exchange Commission, or also known as SEC.
Thank you, Anastasia, for talking about how warrants are currently accounted for in financial reports. My name is Celina and I will be the next speaker. I'll be talking about how the main accounting issue as identified in the SEC statement. The main accounting issue as identified in SEC's statement about SPACs is whether or not the warrants are classified as equity of an entity or an asset or liability. As previously mentioned by the speakers before, a warrant is when a special purpose acquisition company, also known as SPAC, first raises money from investors in the public stock markets. The evaluation of the classification of a warrant is highly dependent on the specific terms of the contract and the entity's specific facts and circumstances. We will be going through two factors of the classification of warrants as equity or asset or liability, which are indexation and tender offer provisions. The first factor is indexation. For warrants to be classified as equity of the entity, the instruments must be indexed to an entity's own stock. An example of this is when there are variables that could affect the settlement amount. However, these variables do not prevent the instrument from being indexed to an entity's own stock if the variables would be inputs to the fair value of a fixed forward / option or equity shares. Please note that there are other inputs that are under GAAP and that this is just one of the many examples. On the other hand, for a warrant to be classified as an asset or liability, the instrument must not be indexed to an entity's own stock. An example of this is when there is a holder of the instrument is not an input into the pricing of a fixed forward option or equity shares, and as a result, it would prevent the warrant from being indexed to the entity's own stock, thereby leading the warrant to be classified as a liability or asset at fair value. We will now be discussing the next factor, which is tender offer provisions. Another way that a warrant would be classified as an asset or a liability rather than equity is when there is an event that is not within the entity's control that requires a cash settlement. An example of this is when all warrant holders and other certain holders of the underlying shares of common stock have a right to receive cash. This would result in the warrant being classified as liability or asset. However, GAAP provides an exception to this provision, whereby the classification of equity would not be prevented if the cash settlement can only occur in circumstances where the holders of the warrants underlying the contract would also receive cash. Examples where this would occur is when there are events that fundamentally change the ownership of an entity. In this case, the warrant will be classified as equity. You will now hear from Marissa.
Thank you, Celina. I will now address the SEC's concerns around current accounting practices. The SEC's concerns regarding the current accounting practices for warrants are valid, as errors in accounting for warrants could produce misrepresented financial statements. Inappropriately classifying warrants as equity leads to inaccurately disclosed liabilities, thereby misinforming shareholders of a SPAC's financial position. As such, the current accounting practice for SPAC warrants should remain the same, that is, by classifying them as liabilities rather than equity based on the specific terms of the contract. Prior to the SEC's updated regulations regarding the treatment of SPAC warrants, it was common for them to treat warrants as equity instruments. However, due to the increased popularity of this form of investment, on April 12, 2021, the SEC declared that treating warrants as liabilities would be more appropriate. Depending on their terms, warrants should be classified as liabilities because if the value of a company's shares rises above a certain level, the company will be subject to a qualifying tender offer and be liable for cash payments. Although it is unlikely that the company will pay out cash, as shareholders would be incentivized to exercise their warrants, a provision liability remains. Additionally, if warrants are classified as liabilities rather than equity, this requires their valuation to be revised every quarter, rather than just at the start of the SPAC, because the cash liability changes as the valuation changes. This results in the use of more complex models and calculations in order to account for the specialized terms that SPACs use in their SPAC warrants contracts. Although this process is more time-consuming for the company, the revalued liability on the balance sheet will be a more accurate representation of the company's financial position based on AASB 101 to the shareholders. Before the SEC released its statement on SPACs and accounting for warrants, SPACs could benefit from taking their companies to an IPO at a quicker rate than traditional IPOs by bypassing the required regulation around reporting standards, internal controls, board governance, and audit procedures. Whilst reducing the time to take a company public is advantageous, the lack of regulation could be harmful to shareholders down the line, especially if the target company does not have a clear and comprehensive plan to become a public company. As such, classifying warrants as liabilities necessitates revaluations every quarter, which increases the regulation around SPACs and makes them less risky for investors. In conclusion, SPACs have become a popular alternative to traditional IPOs over the past decade and will likely continue to be. However, certain disadvantages to SPACs, notably the reduced time for SPACs to build regulatory requirements, could be harmful to investors if not executed properly. Thus, the regulation of SPACs from the SEC will be essential in the years to come to minimize potential legal charges. Thank you.